Managerial accounting, absorption costing versus variable costing. Now, recall our absorption costing income statements for Scenario A and Scenario B. Scenario A, we produced the same number of units as the units we sold, had $240,000 net operating income. Scenario B, we produced 10,000 units and sold only 9,000 units, yielding an operating income of $285,000, the $45,000 difference being in the fixed manufacturing overhead that is deferred to the increase in ending finished goods inventory on the balance sheet. Also recall our product cost per unit under Scenario B. When we produce 10,000 units, our absorption costing product cost per unit is $95. And under variable costing, whether it's Scenario A or Scenario B, our variable product cost per unit is $50. The difference in the product cost per unit is in the fixed manufacturing overhead per unit. Now that we've refreshed ourselves on the data, let's take a look at what the variable costing income statement would look like. And it doesn't matter whether we're doing A or B, because variable costing net income is not affected by changes in inventory levels. Only changes in sales will yield an impact on net operating income under variable costing. So let's see what we've got. Sales, in both A and B, we sold 9,000 units at a price of $200 per unit. So just like on the absorption costing income statement, our sales revenue is $1.8 million. And just like we did on the absorption income statement, we're going to state this in thousands of dollars. Now, the variable costing income statement follows a contribution margin format rather than the functional format that we saw on the absorption costing. So on a contribution margin format statement, the next thing that we see is we subtract out all variable costs. So our variable cost will include variable manufacturing cost or variable cost of goods sold and variable selling and administrative cost. So our variable cost of goods sold or manufacturing cost, again you could label it either way, variable manufacturing cost or variable cost of goods sold. Either will work. That's going to be the 9,000 units we sold times our variable product cost was $50 per unit. So 9,000 times 50, that's going to be $450,000. And we're also going to subtract out here our variable selling and administrative expenses. And you have to reach back to that first data video that we saw to calculate this one. The variable selling and administrative expenses is also going to be calculated based on units sold. So 9,000 units sold. And our variable expense per unit was $20. So 9,000 times 20, that's 180,000 for our variable selling and administrative expense. So sales minus variable cost yields contribution margin. So let's see, $1.8 million minus $450 minus $150, our contribution margin is $1,170,000. $1,170,000. Then we subtract out the fixed costs. In total, and remember the difference between the absorption costing method and the variable costing method is that we expense fixed manufacturing overhead in total. So that's what we're going to see right here. The fixed manufacturing overhead totaled $450,000. And we also want to go ahead and subtract out the fixed selling and administrative. So it's contribution margin minus all fixed costs, not just fixed overhead. So the fixed selling and administrative, if memory serves, were $480,000. So our total fixed costs are $930,000. So contribution margin $1,170,000, fixed costs totaling $930,000. So our variable costing net operating income give y'all time to do the math. $1,170,000 minus $930,000 is $240,000.